Hey guys, welcome to the first episode of the Audit Practically series. In this series, we will be seeing on the audit procedures that are required to be performed across various financial statement line items. So, we are going to kickstart this series with a very critical line item in the financial statements, that is operating expenses. Guys, so this series is especially for those who've completed the CA intermediate and entering into their articleship, or maybe even for those who are pursuing their articleship and maybe want to get an understanding of how audit works or how audit of particular financial statement line items work. Yes, guys, without any further ado, let's just dump into the field of operating expenses, understand how it works, what are we supposed to do, how are we supposed to do, and let's rock it, guys. Yes. So, first, when I come to operating expenses is a line item in the profit and loss account, which all of you are aware. So, let us come to the assertions. Guys, we are starting off with assertions because first we need to understand what are the assertions that are there for a P&L item, and we need to understand what we need to do as an auditor to address these assertions. Guys, first, completeness. What is completeness? Whatever is given to us is complete. So for this, we need to ensure that the operating expenses listing that is given by the management is complete. So how do we ensure completeness? Guys, for completeness, we need to understand something in specific. Guys, so when you go to the annual report of any company, there will be a line item called operating expenses here. And when you go to the notes to accounts, the operating expenses will be further broken down into multiple line items like these, like consumption, power and fuel, rent, repairs, etc., etc. So this operating expenses, which appears on the face of the profit and loss account, is referred to as lead or the face of the financials. And the broad groupings which come here are referred to as the groupings. Guys, now you will be having a question. Okay, let us say the total of operating expenses is 100. This 100 will be derived from the total of consumption, power and fuel, rent, repairs and maintenance, insurance, etc. etc. But how do we know what has to go into consumption, what has to go into power and fuel, what has to go into rent? How does a management designate this? How does a management maintain control over this? Guys, the answer for this is very simple. We have something called GL codes. So GL, that is general ledger. General ledger codes are maintained by the management. So basically, I think you guys have to rewind back to your CA Foundation days where we used to open something called a ledger account. And we used to have this chapter called journal, ledger, and trial balance. So where we used to open a ledger account saying buy balance brought down, to balance carried on, to balance brought down, buy balance carried on. So similarly, these are ledger accounts where journal entries are passed. So what will happen is this grouping is further broken down into subgrouping. So subgrouping will be something like this. So if I just come to the subgrouping, it will be like GL code 1234, which will be consumption of stores. GL code 456 will be consumption of spares. Let us say consumption of stores is somewhere around 10 rupees. Consumption of spares is somewhere around 5 rupees. So basically the sum total is going to be 15 rupees. So sum total is going to be 15 rupees. And here the consumption of stores, spares and consumables is going to be linked in the Excel financials provided by the management like this. So this is going to be 15. And your OPEX total here, this 100, it's going to be the sum total of all these numbers put together. Like this is just a example for a particular line item I gave. So this is how your accounts flow. So guys, very simple. You've got your subgrouping at the lowest level, which consists of your GL codes. Like let's say you have something like repairs and maintenance, you'll have a GL code for repairs and maintenance building. You'll have a GL code for repairs and maintenance plant and machinery. You'll have a GL code separately maybe for maintenance. You'll have a GL code separately for maybe repairs and maintenance others. And you aggregate all of this, you sum up all of this, you're going to get how much is the total repairs and maintenance, or how much is the total consumption of stores and spares and consumables, as the case may be. So in the financials that the management gives, the management usually provides an Excel financial statements. So they are going to link everything to the respective groupings. The subgroupings are going to be linked to the groupings, and the grouping is thereby linked to the face of the financials into operating expenses. So guys, this flow is important because is okay. So I will come to this flow maybe towards the end, and maybe by the end of this video, you will understand why this flow is important. So why is a lead called a lead, guys? It's called a lead because it leads you to the phase of the financials. Basically, when you're doing a subgrouping, then arriving at your grouping, and then arriving at a phase of financials, it is leading you to the phase of the financials. Hence, this is called a lead. That is the operating expenses number that is appearing on the face is called a lead. Then your grouping is called a grouping because you group the operating expenses into various buckets. And then it is subgrouping because it is a further breaking down, it is a further decoding, it is a further deep dive of the various items ranging from consumption, repairs. You're analyzing what is going into consumption, what are the GL codes under consumption, what is actually contained in consumption. So that is what you're analyzing while going into these ledgers. I hope this concept is clear, guys. So now let us go to operating expenses. Let us see the various assertions that are there. So guys, we started with completeness. And when I started with completeness, I came to this topic of lead, grouping, and subgrouping. So guys, in completeness, what are we going to do? So as I said earlier, let us say my consumption of stores and spares contains these two GLs, GL code 1234 and GL code 456. So the total of these two is 15. So what I as an auditor have to ensure is that is this 15 flowing to the consumption of stores and spares and consumables that is there in the footnotes. If this is also 15, I don't have any concerns. And I also have to ensure that the 15 which is here is contained in the total of operating expenses, that is 100. Basically, I have to ensure that the 15 is also included in this 100. Similarly, I have to do this for every single line item. So basically, usually how we start as auditors is we basically take the subgrouping from the last year and we arrive at the grouping, then we arrive at the main lead or the phase of the financials. Then we see if there is any difference. If there is any difference, we understand whether the management has added any new GL codes during the current year because of which the difference is arising in the subgrouping. If yes, we need to understand what is the nature of those GL codes and why they were added. Guys, so if your 15 of the GLs is tying to your 15 of your consumption of stores and spares, and if your 15 is contained in the 100, you are able to ensure completeness as an auditor. You are able to get comfort over the fact that everything is included in the ultimate phase of the financials. So you need to do this for every single line item ranging from consumption, power and fuel, rent, repairs, and till the very end, till maybe probably the last item, which is corporate social responsibility expenditure. So this is how we need to ensure completeness, guys. So many of you might have this doubt, like, actually, you might be thinking like, isn't completeness like ensuring whether management is recording every single expense or not? That is practically not possible for us to ensure as an auditor. Yes, that is completeness, but that is an inherent limitation in audit because we obviously cannot ensure whether management is recording every single expenditure. Because let us say management has received a service and let us say management has to pass the entry expense to payable, but they have not even passed the entry, we would not be able to find as auditors because we can only find what is presented to us. We cannot dig and investigate, right? So this is basically completeness in the context of audit, basically ensuring that whatever is there in your subgrouping is perfectly flowing to your grouping and whatever is flowing to your lead. I hope this is clear. Now coming to accuracy, guys, what is accuracy? Accuracy means basically whatever is here, like let us take a simple example of your CA foundation or a CA inter. Let us say you went to the online site, you saw your score, you got somewhere around 70. Let us say when your mark sheet comes, it also has to be 70 there, right? That is how it has to match. Similarly, for operating expenses, what we will do is basically, as I mentioned here, GL dumps. Let us say, for example, consumption of stores is one of the line items. Let us say, or maybe let's take the example of insurance here. So maybe insurance would be better to understand. Yeah. So let us say there is a line item called insurance. Let us say insurance has rupees 30 as an expense. Let us say insurance is further broken down into multiple GL codes, like your general insurance is there, your insurance for your inventory is there, your insurance for your plant and machinery is there, like multiple GL codes are there. Let's say you select a particular line item. So you select a particular line item and you ask the supporting for the line item. So why do you need a supporting is because management has passed an entry. On what basis would the management have passed an entry? Like for example, insurance. Management would have for example, insurance. Yeah. So management would have received an insurance service for which they would have booked the expense, right? So what do I need to see for insurance or any other operating expense as a matter of fact? Let us say the management has passed an entry for 5 rupees in a particular line item in one of the GL codes in insurance. So what will I see to obtain comfort over the accuracy assertion as an auditor? I will see the invoice, PO, and GRN. So guys, I think most of you would be aware of invoice. So invoice is basically the document that is issued by the supplier of the goods or the service to us for basically evidencing the fact that this is the amount that of the expense or amount of services he has rendered, which is basically 5 rupees. So this is fine. And there is another thing called a purchase order. So basically a purchase order is a quotation which is raised by us to our supplier saying that so we need so and so services and we agree upon so and so rate for these services. So what is the relevance of a purchase order here? So purchase order is like an agreement case. It is not an agreement, but it is like an agreement. So in a purchase order, you would have the rate for a service. For example, let us say 5 is the expense booked here. Let us say the purchase order value might be around somewhere around 30 rupees. You might be like, why is the purchase order value of 30 not matching with the invoice value of 5? Guys, basically, purchase order might be for a variety of services. For example, 5 might be the expense booked for April month. So 30 might be the insurance policy taken for maybe 6 months. So maybe 30 might be the insurance policy taken for 6 months. So basically the sample of the line item of rupees 5 which you had selected might be for a particular month, because of which you are able to understand that if 30 is for 6 months, I am able to get comfort over the fact that the rate that is agreed per month is rupees 5, which is what is also built in the invoice. So I am able to trace the rate from the invoice back to the purchase order. So this is what happens, GRN. So GRN is basically a goods received note case. So GRN is more relevant in the case of goods, but there is a similar concept called service entry for services. So I am going to explain this in the context of SAP, which is an ERP, so Enterprise Resource Planning System, basically your accounting system, which is integrated with the other modules as well. So this is what most of the audit clients would be using. Yes, there would be audit clients who are using Tally as well, but I'm going to explain this in the context of SAP so that you understand this better. So guys, so there are two things. So first I'll explain this in the context of GRN. Let's say I'll explain this in the context of a purchase of material so that you understand the same logic holds good for services as well. I'll explain this. So just coming here. So guys, you purchase or you purchase something. So or you incur an expense. What entry would you pass? You will first debit the expense and you will credit the payable, because expense is a nominal account. You debit all expenses and losses, you credit all incomes and gains, and you credit your payable, right? But in SAP, you do not straight away pass the payables entry. So you park this in a temporary account called GRIR. So why? So why do we need to park this in a temporary account? Yes, guys, hold on. I will just explain this. So GRIR is goods received, invoice not received account in SAP. So in this account, you will, so this entry for materials, let's say this is the case of materials. So this entry will be passed by the stores team, expressed to GRIR. Let's say for maybe 5 rupees, this entry is passed. Because this is because guys, the stores team will not have access to the finance module, which contains the list of the payables, which contains the vendor master data. So guys, this is because you will have access restrictions. Obviously, for example guys, let us take a person in a HR team. I think many of you guys would know this. A person in a HR team would not be passing accounting entries because he is in no way connected with the finance function. So ideally, he would not be having access to the finance module. So SAP is an enterprise resource planning software, which is basically subdivided into a variety of modules, guys. This is because you are able to maintain all the data in relation to your company at a single place and it all gets integrated. Like guys, let's say earlier, maybe 20 years back, you used to have your emails on your PC. You used to make calls on your mobile phone, which was not an automatic phone or which was not a smartphone. But now in today's context, you have your mail synced to your own phone. You have your WhatsApp backing up in your G Drive. Everything is synced, right? It gets easier, right? So that is what SAP does. SAP is an integrated system. So in this case, the stores department will have access to the stores module only. They will not have access to the accounting or the finance module, because this will help them to ensure that they track the materials that they are receiving or the goods that they are receiving and do not have unauthorized access to the finance module, which is in no way connected to their function. So the finance module, when they get the invoice for this, they will pass the entry GRIR debit to payable. So when the finance personnel passes this entry, they will ensure that the rate as per invoice is matching to the rate as per the PO, and the rate as per the invoice and the PO is tying out to the GRN. Basically, the stores team, while passing this entry, they will pass this in, they will create a document called a goods received note, which is mostly system driven. There are still few companies which do it manually, which have a physical paper on which they pass the GR and they stamp it and they use it for control purposes. There are also some companies which have a separate software for GRN passing, which is integrated to SAP. So there are a variety of companies which do it in different ways, but this is basically what it does. And this concept is called the three-way match case, where the finance team reconciles the invoice, PO, and GRN. So this is the case. This is how it works in case of goods. So this is how it works in case of goods. So yes, so coming back to our point, in case of accuracy, we will see these three documents: invoice, PO, and GRN, guys, to ensure that the entry the management has passed, like the expense to GRIR entry of 5 rupees, is accurate. That is, it is backed by underlying supportings. Because you cannot pass entries in thin air, right? It has to be backed by something. It has to have some basis for it, right? Which is why we need to look at the supporting and get comfort over accuracy as an assertion, right? Yes. Existence or occurrence, guys. So this is again this is again a very important assertion in case of an expense. So guys, occurrence. So what is occurrence? Let us say we were talking about insurance as a service. So let us say the 5 rupees of insurance that was passed, entry that was passed, was for an insurance service that was taken by the management. So how do we get comfort over the fact that the management has taken the service? Yes, many people might say invoice in itself is a comfort over the fact that the management has taken the service. Yes, definitely, I agree. But we need to see something corroborative as well, right, to obtain additional comfort. So one of the corroborative things you might see, for example, in case of an insurance is maybe you can look at the mail communication between the insurance company and the management saying that where the invoice has been sent, because you may not know that the invoice that the management directly provides to you might be fabricated. Maybe so when you see a mail communication from the service provider, from the insurance company to the management containing the invoice saying that they have provided the service, or maybe for example, let us say in case of a maintenance service, let us say the management, let us say the maintenance is for, let's say, a software. So let's say a technical person comes and provides a maintenance service. Let's say he is going to say that P into Q, basically number of hours worked into the rate per hour is the amount that I'm charging you for the maintenance service. So in that case, you will be able to understand that, okay, this is the basis for the amount. The person has actually come inside the premises and he's actually rendered the maintenance service. So occurrence is again an important assertion, guys. Cutoff. So what is cutoff? Guys, cutoff means the expense is recorded in the right period. So basically, let's come to our example of insurance itself. Let us say the insurance service was received for the month of March 2025. Let us say that the financial year we are looking at is financial year 24-25. Guys, what should be the scenario here? Ideally, this expense should be booked in financial year 24-25. So let's say there is a scenario wherein the insurance company bills the management on 2nd April 2025 or 3rd April 2025. The management is telling you, sir, we have received the invoice only on 3rd April 2025. So we have not booked the expense for the financial year 24-25. Is the contention of the management right? No, it is not right. Because we follow accrual basis of accounting. And Companies Act also tells us to follow accrual basis of accounting for books of accounts for companies, right? So as per accrual basis of accounting, we have received the service for March 2025, which is falling within the financial year 24-25. Hence, the entry that should have ideally been passed was expenses account debit to accrual, right? So the management should have ideally accrued the expense, which they have not done, which as an auditor you have to ensure. So you will get to know this while you look at the GL dumps, GL codes. You will get to know the entries that are passed and you will be able to understand this. I'm not really going into those intricacies now. Maybe when you get to the field level, you will get to know these better. Yes. So this is one thing, guys. And classification and presentation and disclosure both go hand in hand. So about presentation and disclosure, like guys, Schedule 3 prescribes how your presentation and disclosure should be. If it's an Ind AS company, it is Schedule 3 Division 2. If it's an AS company, it's Schedule 3 Division 1. Guys, so yes, so it is very important because you need to comply with Schedule 3 with regard to presentation and disclosure. For example, your grouping has to be like this. Your grouping has to use the terminology set out in Schedule 3. And if let's say there is a, so let us say I just come down. I am having a head called miscellaneous expenses here. Let us say if there is an item which is exceeding 1% of revenue from operations or 10 lakhs, whichever is higher. So 1% of revenue from operations or 10 lakhs, whichever is higher, I need to disclose it separately. Like for example, let's say in the miscellaneous expenses, there is one item which exceeds this threshold. So let us say that item is probably security charges. I need to disclose security charges separately. Like let us explain this with numbers. Let us say my revenue is 100 lakhs, or let's say my revenue is 200 lakhs. So what is 1% of my revenue? So 1% of my revenue is 2 lakhs, right? Or 10 lakhs, whichever is higher. Let us say my security charges are somewhere around 14 lakhs. Guys, so ideally this is exceeding, so 2 lakhs or 10 lakhs, whichever is higher. Which is higher, guys? Obvious, 10 lakhs is higher. So in this case 10 lakhs is higher. I have to compare this 14 lakhs with 10 lakhs. So 14 lakhs is exceeding the threshold of 10 lakhs. So the security charges, I have to separately disclose it here. Maybe put an alphabet T and say security charges 14 lakhs. I have to remove it from miscellaneous expenses in the disclosure and present it separately. So this is to make the readers understand that, sir, there is a significant item which we want to present separately, which would warrant your attention because it is material. We want you to understand this nature, which is why we are showing it distinctively. Yes, right? Understood, guys? I think presentation disclosure is also clear. Valuation, guys, let's think sensibly. This is a profit and loss account item. Will valuation apply to it? No. It is not a balance sheet item. Where would valuation come in case of an expense? Right? Let's just strike this off. Done. Perfect, guys. So we have understood the assertions, guys. So guys, I explained about how you need to ensure completeness, accuracy, existence or occurrence, cutoff, classification, presentation and disclosure, right? Guys, now coming to analytical procedures. So guys, you have an essay called Essay 520, which talks about analytical procedures. So guys, what could be analytical procedures? For example, like let us take an example. Let us take an example that you guys probably know. So let us say I come to like something like a power and fuel. Guys, power and fuel is, in case of a manufacturing industry, will be driven to a great extent by production. Let us say you know the production of last year, you know how much power and fuel was incurred in the last year. You can maybe do an analytical procedure saying, for this much production, this was the power and fuel cost I incurred. So for this much production in the current year, how much power and fuel cost should I incur? Yes, there might be some one-time expenses that might be sitting there in power and fuel, maybe in the previous year or in the current year, which you need to scrap out and do it in the analysis. This is one of the analytical procedures you could do to understand whether the variance is in line with the expectation, because that is what your Essay 520 says. Your Essay 520 says, tells you to establish a relationship between two variables and see whether they are in line with the trend or not. If it is not in line with the trend, you need to understand from the management what is the reason for the same. You can get an understanding of the same, because when you are just performing a substantive procedure, so your OPEX vouching, that is where you ensure the accuracy part of it, that is a substantive procedure which you're performing. When you perform an analytical procedure, you get a bird's eye view of what is there, what should be there, what is not there, what should have been there, what is not actually there. And you get a better understanding of the business. You get a better understanding of what should ideally be ingrained in there, what should not be in there, right? So that is one thing. Next, let's say, scanning of expenses, guys. So scanning. So why is scanning important? Guys, I just told you something, right? So we were talking about an example where the security charges were initially grouped under miscellaneous expenses, and you got to know that it is exceeding the threshold for materiality as per Schedule 3, and you were required to present it separately. Guys, when would you know this? Would you know this when you were merely just selecting samples and tracing it to the invoice, PO and GRN and seeing the occurrence for the same? No, you would not get to know this, right? You will get to know this only when you deep dive into the GL dump. You see what is there in the GL dump, what are the nature of items that are there. Maybe you pivot the text of the GL dump with the amounts, and you get to know that, okay, this is the nature of the items, this is what is there, this is what is not there. Only then would you get to know, right? Yes. So that is why this is important, because if there is an item which not ideally be contained in there, you ideally need to reclass the same. For example, let us say the client has a GL code in relation to security charges, which is grouped under professional expenses, which should ideally not be the case, right? It is a miscellaneous expense, or if it is significant, it is required to be presented separately, right? You will get to know this only when you see what is contained in each CLM. Another example might be like you have your packing, dispatching, and freight. You have two packings, right? You have your primary packing, you have your secondary packing. So primary packing is the packaging without which the product cannot exist, right? So for example, let us say a milk packet. A milk packet is a primary packing, but let's say the milk packets are loaded onto a big carton. The big carton is a secondary packing. So the cost of the secondary packing should be taken into P&L as an operating expense, while the cost of the primary packing, that is the cost of the milk packet itself, should not be taken to operating expenses. It should be taken to cost of goods sold. It should be taken to cost of materials consumed, right? Because it is directly attributable to the material, and this is the treatment that is required as per your AS2 or your Ind AS2, depending on whatever company you're doing. So that is the case, right, guys? So you will get to know this only when you go into the dump. You see what is there in the dump. Should it be there? Should it not be there? Why is it there? Should it be there? You need to ask these questions. You need to keep brainstorming, and you will get the answers to these questions. It all just comes with experience, guys. You just keep doing it day and night, and you will get a hang of it. That is there. And guys, so scanning of expenses, guys, for each of these line items, let us say consumption, power and fuel, rent, repairs and maintenance, scanning is very important. So some of these items require a special kind of scanning. So what is special kind of scanning? What are you saying, bro? You might have this doubt, right? Let's break this. So if I just come to something like a rent, so guys, many of you might know that an Ind AS company is required to comply with Ind AS 116 for the leases it has taken as a lessee. So it has to pass the entry ROU asset debit to lease liability. So, but there are certain exemptions or practical experience that Ind AS 116 provides, where it says that even though it is a lease, you are not required to apply the Ind AS 116 accounting, and you can merely pass the entry as rent expense debit to bank or rent expense debit to payable to bank. You can pass these entries. It is perfectly fine. So I'm not going into these exemptions in detail. You will get to know them in the course of your work as and when you're doing the same. This is just to give a broad overview of what you're required to do. So you may be required to evaluate each of the rent agreements as to whether they qualify for lease accounting or have they been rightfully expensed off. You might be required to do that. For example, if I come to repairs and maintenance, you need to understand whether the repairs and maintenance are in the nature of capital expenditure or revenue expenditure. Because if they are of the nature of capital expenditure, they ideally should be capitalized in accordance with Ind AS 16 or AS 10, as the case may be. And if I come to I'll come to rates and taxes and your professional charges separately. And maybe so coming back to rates and taxes and professional charges separately, guys, rates and taxes and professional charges are really, really important items. Guys, so why are rates and taxes and professional charges important? Let us look at the technical aspect of it and let us look at the rational aspect of it, technical aspect of it. Coming to SA 250. So SA 250. So consideration of laws and regulations in the audit of financial statements. That is what SA 250 reads, right? So as per SA 250, an auditor is required to look into two types of laws. One, laws and regulations which directly affect the financial statements. Two would be the laws and regulations, non-compliance with which would have a material impact on the financial statements. So basically, the type 2 would be the cases where they do not have a direct impact on the financial statements right now, but if there is a non-compliance, it would have a material impact in the foreseeable future. So guys, in relation to your rates, in relation to your laws and regulations that have a direct impact on the financial statements, you are required to perform audit procedures over the same. You're required to obtain reasonable assurance over the same. For example, a case would be like your GST loss. So you have to see whether your ITC, which you have availed in your GSTR 3B, is it eligible credit or is it ineligible? If it is ineligible, it should not be an asset. It has to be expensed off as per section 17.5. You need to understand these things because it is a law and regulation which directly affects your financial statements, right? So that is one thing. So you need to understand that, guys. Next, maybe there are also laws and regulations which do not directly affect your financial statements. For example, let us say there is a pollution control act which is applicable to the entity. Let us say the entity maybe dumps the effluents into the water without treatment. In such a case, the activity done by the entity does not have a direct effect on the financial statements. But let's say, guys, maybe in the future, let's say if a regulatory authority comes and imposes a penalty, in such a case, the entity may be required to provide for the same in the books of accounts. And if the entity does not provide for the same, it would have a material impact on the financial statements. So this is a kind of the second type of regulation. So the second kind of regulation, you can understand the same by looking into the legal expense account. You can look at the rates and taxes account to see if there is any penalty that the company has paid. So you need to scan the rates and taxes account to see if there is any penalty that the company has paid, which is grouped in the rates and taxes. And You can also look at the professional charges expenses to see if there is any legal expenses that the company has incurred towards particular litigation. And again, with regard to your SA 501, so audit considerations for specified items, your SA 501 requires to understand the status of litigations. It is one of the most important things in SA 501. So SA 501 also tells you to examine the legal expenses account. So you're examining the legal expenses account is very important, guys, because there might be certain cases which the management might not have disclosed in the litigation tracker, but which might be here. For example, how do we identify this? So most of the lawyers, what they do is when they raise an invoice to the client, they give a case by case status. They say 100 rupees is for case 1, 20 rupees is for case 2, 30 rupees is for case 3. So you will get an understanding of what are the cases towards which the company has paid an amount. Let us say the company gives you the litigation tracker. Let us say case 1 is disclosed in the litigation tracker, case 2 is disclosed in the litigation tracker, but case 3 is not there. So you would be going to the management asking them, sir, you have paid an amount for case 3 as well. Why have you not disclosed it in the litigation tracker? Does case 3 require a provision or a contingent liability? If it requires, why have you not provided for the same? And what would be the possible impact or implication on the audit report as an auditor for you? So these are some of the aspects you would look into, guys. Guys, I hope you loved this session. I think you got a better idea of what is to be done. And guys, many of you might be like, why am I not speaking about CSR? CSR is again an ocean. So corporate social responsibility is again a very important section in the context of section 135, and the computation also has to be done in line with section 198. I think for those of you who qualified CA Inter recently, you would know what would qualify as a CSR expenditure. You would know what would be there in the Schedule 7 list. So I'm not really going into the details of that, because these things you can definitely study on your own. You can definitely get a grip over what is to be done, what is not to be done. So guys, really happy on doing this session. Looking to connect more with you. Take care, guys. Bye-bye. Cheers. And most importantly, keep learning, keep growing, and stay humble. Cheers. Thank you. Goodbye. Good day. Thanks.